Well, here we are again, folks. Great to see you on Tuesday evening. And for those who were on last night as well, it's getting a habit, isn't it? I actually asked earlier on whether people wanted more live shows. Believe it or not, they're actually easier to make than pre-recorded shows, because on pre-recorded shows you have to do all the script writing and the recording and the editing and post-production, whereas on the live it's either there or it's not. So, anyway, good to see whole crowd of people on and some new names too. It's excellent to see everybody there. Just a few acknowledgements. It's very interesting to just go through the list and see some of the old faithful. One bird just said we love meatball. Yep, the dogs are around. I'm not sure whether they'll wake up or not, but if they do, then they might make an appearance as well tonight. It's certainly interesting having them down here. And just for you who may or may not know, we're having to make some changes because my wife is very ill at the moment, and so the dogs now are with me in the studio rather than somewhere else in the house, which is why well, they could golf at any time, so watch this space. And as somebody else said, the futures markets are down a bit in the US. I think somebody mentioned the Omicron might be more difficult to deal with than others hoped, so we'll see. Anyway, I'm sure we're going to discuss that in a second. And I think without further ado, let me take the pre-show off and run the intro, and then we'll get on with the main show. Stand by. Well, good evening and welcome to this live stream event on the 30th of November 2021. Martin North from Digital Finance Analytics here. Great to have you on board this evening, and we're going to have a really interesting conversation with Damien. He's queued and ready to come in just a moment, and lots of things to explore tonight with regard to the markets. I think they're pretty skittish, lots of different factors pulling in different directions. Of course, Jerome Powell is going to be talking on Capitol Hill, I think, in the next sort of few hours, with some thoughts there as to what he might be thinking. So lots of different things to explore, and markets are a bit wobbly even as we speak, so it could be quite interesting. Anyway, before we just bring Damien in, let me just remind you, as always, that we don't provide financial advice or legal advice on this channel. This is a general conversation only. Please play nice in the chat room. We do moderate the stream. This is as at the 30th of November 2021, if you're watching this in replay. If you want to get my attention, ask a question, use @WalkTheWorld to make sure that I see it. That's the best way. But also you can use Super Chat, and Super Chat enables you to get your questions to the top of the queue. But also, if you want to make a contribution to help us with some of the expenses relating to running the shows, that would be great too. But without further ado, let me get rid of that, and I'm going to push this button, and if I do, he should appear. Damien, hello.
Martin, success.
Hey, it worked. I always hold my breath when I push the button.
Yes.
How you doing?
Yeah, great. Good to see you again. It's just been we were up visited Martin in studio just a couple of days ago, so yes.
Yeah, you can now envision me sitting here in the studio, right, with everything that's going on here.
That's right.
Sitting at my little control console and pushing all the buttons and things like that. So,
and hoping the dogs aren't doing the same. Yes.
The dogs remember to sound asleep. I actually took them out just before I came on air, and it was very humid and hot, so they went around and sort of just went flop down afterwards. Anyway, lots to talk about tonight.
Yeah.
A lot of people concerned about the sort of shape of the markets and what's going on and all those things. What's your take? I mean, it seems to me there are so many uncertainties. It's probably as uncertain as I can recall.
Yeah. So look, I think there's it's interesting following the reactions to the latest virus outbreaks and what's happening there, because I think there's certainly a reasonable part of the market, and myself included, who had taken the view that, look, people are pretty much over the lockdowns, and that what we'd start to see now is increasingly strategies to try and live with the virus. I guess as you've seen, I guess right throughout the UK in particular and the US. Now the question is, are we going to see some variants? And we've obviously got one going at the moment that's caused a few concerns. And so the real question will be now, do markets, what are the economic fallouts, and do we actually see another wave of fiscal stimulus? I think the fiscal stimulus is probably got some pretty high hurdles. I think a lot of countries are now starting to worry about the debt, and so it really does come back to central banks to try and bail you out. So some of the strategies we've been implementing to try and I guess take a bit of an each way bet on these is one is the US dollar and getting funds offshore, and that's worked to the extent that we'll have to see how things go tonight, but I think for the month anyway, we're certainly up versus in the international a reasonable amount, despite sort of ructions in the market because the Aussie dollar's been falling. We sort of took some bond positions to try with a view that we did think that the bonds markets had run too far, but it also gave you this hedge if market conditions did turn a little bit south. And so now the question really comes down to I guess valuations and growth, and really looking at which companies are going to manage to keep growing through this, and which ones are the ones that are going to suffer as we if we need to go back into various versions of lockdowns.
And it's interesting, isn't it? Because Jerome Powell, in his acceptance speech of his second term, specifically made a comment about inflation. Right now, every time Powell was talking about inflation previously, he always said it's temporary, it's going to rectify itself. And in fact, in his submission to the speech that he's going to give tomorrow on the Capitol, he said the same thing again. But he didn't say it in his acceptance speech. And a lot of people read that as, he's now thinking it's not transitory, it's actually, sticky and long term. What's your perspective on that?
Oh, look, I think you can spend a long time, and then there's plenty of people who pore over every word and every missed word. Like this, in this case, it's not something he said; it's something he didn't say. And so, look, I think the central bank there is cognizant that they do want that unemployment is still quite high, and that if they can push. That I think they want to try and push growth as far as they can without letting inflation get out of control. And I think in their view, while inflation certainly has bounced higher and is obviously a lot longer lasting than they expected, I don't think they're looking at it and thinking that this is inflation that if you raise interest rates, you're going to get control of. So, let's say, for example, used car prices have skyrocketed is because people haven't been able to get into cars to buy new cars because the new cars aren't available. Problems with the supply chain that are sort of forcing up, whether it's the price of lumber or things like that. And so I think at that point with unemployment where it is, it's not a matter of people going out and borrowing money as much, and it's not sort of these irrational spirits and this huge growth that's sort of sucking everything in that needs that needs interest rates to bring it back down, but it's more problems in the supply chain. And you're raising interest rates, you could cause a recession in terms of to smash the demand, but that's still not going to fix your supply problem. And so I think there's a little bit of recognition within that is that that you can't you need to work out why you're actually raising rates, not just for the sake of rates themselves, but actually to really get the inflation you want under control.
And there's that old story, if you've only got a hammer, then everything looks like a nail.
Everything looks like a nail. Yeah, that's right.
And in a way, the point about what you've just said is really important, right? There are lots of different types of inflation, and they're behaving in quite different ways. But raising interest rates doesn't cure supply chains.
No, that's right. And so what you want to, I guess, the key thing for raising interest rates is when demand is getting out of control. You're seeing lots of wage rises. Unemployment's getting quite tight. You're seeing people going out and borrowing money left, right, and centre to try and expand and grow and everything like this. And you're in this sort of a boom and very high consumer confidence at that point. And that's not the type of boom we have at the moment. That's not, the ones that are worried about supply chains is about saying, well, we actually what we want is we want companies to reinvest in their supply chains or go and to actually get through these problems so that sort of solves your issues. Whereas giving the economy a recession to dampen demand to fall to meet reduced supply is not really in the. I don't think it's in their best interest, and I don't think that's what they want to do.
No, and in fact, Gregory makes an interesting point. If you raise rates, you'll have a financial meltdown. So print more money. The point is, we are very, very leveraged. Look at private debt, look at corporate debt, look at government debt, and interest rates, if they go up, that's going to lift the cost of debt dramatically, and that could actually cause a deflationary event rather than an inflationary event. Yeah,
well, I mean, we're already seeing that in Australia. So, we spoke last week about it, but the idea that the RBA has effectively let the market dictate, and we're seeing that in fixed rate mortgages going up. And so, the question that will really be the I guess a bit of a litmus test in Australia is can we handle higher interest rates, because despite not officially raising interest rates, we have in the sense that the 3-year mortgage rate is on the way up.
Yeah, and my surveys and mortgage stress stuff, which I'll be talking about next week, for those going to come on the show, shows that there are a lot of people who can't, quote, cope with even small rate rises from where they are. And in fact, the credit numbers that came out today showed some growth, but not quite so much growth as previously. And I think we're probably over the peak of the lending cycle in Australia. That's because people have a hangover because they got so much debt.
Yeah, absolutely. And there's also this part about I think of the housing market as really having a structural supply problem as well, insofar as we had the biggest apartment boom we've seen in God knows how many years, maybe ever, I guess, within Australia. Just as we roll into a pandemic, and then all of a sudden it's like, well, nobody wants to live in these apartments now. Because everyone wants to get a house and a yard in case I get locked down and more space. And so now we're going through this massive house building boom. And so, I guess some of it is this these frictions in terms of we haven't got the right supply and we need to get the right supply to actually sort of satisfy people's demands within that.
Absolutely. And then Fraser made an interesting comment here, which was, we've got to stop relying on debt to run Western economy as well. Don't change the habits of a lifetime, right?
Yeah, that's right.
It's been the same thing again and again and again and again, and more so. My question is, why wouldn't you go on doing it?
Yeah, look, I have sympathy for you, Fraser, but it's a bit like the world peace. That's what. We'd love to have world peace, but the tool we have at the moment, which makes the most sense. And actually, let me take one step back because I do want to. There are ways to solve this, but the easiest way is to try and inflate our way out of it. So you have a debt problem. You've got the different ways you can deal with it. One is you can let the creditors sort of bear the pain of what they're misdoing. And let them take losses, and we showed it in the last financial crisis. That's not an option in most developed countries now. Iceland did it and bounced back pretty quickly, but they're a tiny country. But almost every major country just bailed the banks out, moved on to the next, and we're seeing that sort of starting to play out in China as well. They're obviously trying to manage that slide. So that's sort of one way you can deal with it. And another key way is to print lots of money and inflate your way out, and so that's a much easier task because it doesn't feel like it hurts as much, and people don't really notice it as much, and we're just sort of taking a little bit from everyone and inflate your way out of that debt problem, and that's so if it's a choice of something that sounds tough and something that's got, how do I put it? Is usually if you give a politician a choice between short-term pain. Short-term pain for long-term gain, or vice versa. A short-term win for a long-term pain. They'll take the short-term win for the long-term pain every time.
And it's worth just reflecting on that. Inflation effectively is a hidden tax, isn't it?
Yeah, absolutely. Yeah. So I've talked about inflation and the issues I have in terms of being transitory, but I do think over the longer term, this is the way to get out of it, and the way that we most likely will get out of it. But I guess that from my perspective, the inflation we're seeing now is a mixture of a whole bunch of one-off transfers from governments to consumers, and things like JobKeeper and stimulus checks in the US and all that type of stuff, and then supply chain issues. So I think it's a broad mixture of the two, and so I don't. If they keep on doing those, then if they keep on sending out more checks and more transfers from governments, especially to poorer people, then you can expect to see inflation. But it does look to me as if that stage of it's finished, and now we're talking about how do we roll the stimulus off for most governments, and everyone's worried about the debt. There's headlines out today about Victoria's debt, and last week about the federal debt, and that'll start becoming an issue for some people.
And just on that, and particularly state finances, of course, New South Wales announced a huge windfall dividend from all the stamp duty. Massive, right? So, convenient that this housing boom has actually led to a lot of coffers at the state level being pumped up.
Yeah, that's right. So, we've had a win-win-win. Like, so it's free money, and let's do it again. We'll just people borrow money and use that to pay stamp duty, and so it's exactly that sort of short-term win for a longer-term gain. There's a longer-term pain that we spoke about. And
of course the election is this year, so that's another factor to bear in mind when people think about what may or may not happen. Now it's interesting, Cookie Boy asked, we might as well pick that question up I think from him, which is this: will the RBA raise rates next year? Because they're still saying, oh look, it's going to be 2024, whatever. The markets are saying no, it's probably 3 moves in the next year to 18 months. They can't both be right, can they?
No, that's right. I'm on the side that they won't be raising rates. But let's go through what would cause you to go one way or the other. So the main reason why you would start raising rates is if you see China sort of backflip on their property sector and start bailing it out again and throwing lots of money in terms of getting that whole iron ore market going. And just that whole debt-fueled finance, which is possible, but I don't think it's likely at the moment. They do seem to be on the case that this is a managed downturn. They're all the packages I've seen are talking about, and I'm talking about bailing out property developers and trying to give money to those. It's talking about the other sectors. They're going to try and keep the other sectors going so the whole economy doesn't implode, because property is such a huge part of that. So
too big. They
probably will backflip it. Yeah, that's right, and they probably will backflip at some stage, but I think they'll take a lot more pain first before. And given the boom in manufacturing, there's basically never been a better time for China to do this. So they've got this manufacturing sector booming. They know they need to reduce the size of the property sector. So this is their best chance. So if they backflip, that'll get you some rate rises. I don't think as I said, I think China will be working that down. And then the question in terms of there was some extraordinary stimulus that went into the Australian economy, and you look at the number of companies that got JobKeeper and didn't need it. You look at the number of companies that got some of these other cash flow boosts and things like that. Literally billions and billions of dollars. Like economies generally, what matters is to change from year to year. So it's not as much the absolute level, but it's like if you saw a massive amount of stimulus the year before, but not much demand, and then this year that stimulus falls to much lower levels, then you've got to see demand pick up to replace that. And I'm not expecting to see as much of that demand come through.
No, I mean, I've had the view for some time that the economy is a lot weaker than a lot of people think. And, whilst people are talking it up, et cetera, and there's an election and everything, the absolute parameters don't look that powerful at the moment. And therefore, I'm not sure that the interest rate rises are there. Now, of course, somebody said, I think it was Cookie Boy said, the Cook's calling rate rises as high as 3%, right? Well, gee, at 3%, there'll be a lot of people who would be in deep doo-doo.
Yeah, that's right. If you're happy to have a housing crash, then yeah, absolutely, 3%. I think our Reserve Bank and APRA have shown though that housing crash is the last thing they want, and they're actually quite happy to be blowing housing bubbles to keep things going along. So I think 3% is it would need extraordinary circumstances to get to 3%.
Yeah,
I think
I tend to agree at the moment. I just don't see it. And I had somebody, in fact, I ran the live stream yesterday with Lou Christopher talking about his price scenarios, right? And he basically had a scenario that said, well, you might see over the next year or so a small increase in interest rates, but it was really quite small. And he said, look, I don't see any argument for a higher level of rates in that period, and I tend to agree. But it's not necessarily the most popular view at the moment. If you talk to people out there in the markets, and particularly the traders who are trading and taking positions on the assumption that actually rates are going to go up, and their argument goes like this, Damien: if in fact the Fed and the Bank of England and everybody else keeps putting rates up, which they might do, if we don't follow suit, then the exchange rate drops dramatically. That then creates a whole bunch of complications and inflationary complications and things. So it's almost like whatever they might want to do locally, they may not be able to do it simply because of the international context. I don't know. My take is I'd love to see a lower Aussie dollar, and my read is that the RBA would probably prefer to see a lower Aussie dollar as well. So I guess I'd look upon that as a good circumstance, a chance for Australia to reset a little bit after running. We've been running our exchange rates at such high levels for basically since the mining boom, sort of in the early 2000s, which just meant our entire manufacturing sector shut down. So unless we want to produce. If we don't want to produce anything sort of smart and have a manufacturing base and all that type of stuff, then keep the Aussie dollar high. If you do want to try and build that out, then a lower Aussie dollar would be welcome. The other one I was going to say on that as well was the other reason why I think there is a lot of expectation is because I think Australia gets grouped into with other countries, in particular New Zealand and Canada, are looked upon as two quite similar economies to Australia. And they're both raising rates and going through that. Much interest rates there have risen a lot faster, and so I guess the issue in terms of that is I think there's a lot of people just sort of going, well, if those countries are doing it, then Australia's next, I guess, and I think Australia is different enough in this circumstance. This is interesting, and certainly there are some differences. I look over at New Zealand. Of course, New Zealand has lifted rates twice, and out 0.75%. And in fact, they in their statement on monetary policy that came out last week, they had this amazing chart that showed basically house prices going up 30%, and then they're projecting they'll drop back down again, right? In growth rates, that is, not absolute value. And basically they're saying we're going to have to do more of this. So they've got a very different view of the economy. Now, maybe New Zealand and Australia just have a different economy, a different base, a different mix of commerce underneath it. But it is interesting just looking across the ditch and seeing the difference between the two.
Yeah, absolutely. And I guess what I'd say the big difference is the energy side and the coal and the iron ore in particular that sort of really push the Aussie dollar in terms of demand up when they're strong and pull it back down when they're weak. And we've sort of been through some extraordinarily high iron ore prices, and I think we're seeing the other side of that come back now, and they'll certainly suffer from what we're seeing happen in China in that whole construction slowdown.
Absolutely. Let me just acknowledge Jason. Jason, thanks very much for your Super Chat contribution, and I just want to read this out. So thanks for your perspectives. Appreciate it. Hit the like button, peoples. Cost nothing and will help out Martin towards covering his costs of bringing this to us for free. Blow the bubble bigger before it pops. Yeah, that's exactly right. But please like the post, guys, because it makes a huge difference to the way that the YouTube algorithm propagates. and you wouldn't believe the difference between little likes and lots of likes. And the other thing is, if you can share the post and spread the word, because it makes a big difference to what happens to all the shows. And some of the best shows go really, really well. Some of them go less well. So, and thank you, Jason, once again for the super chat. It is greatly appreciated.
And I'm assuming you're putting this as one of your best shows, Martin.
Of course, yes. You always do. It was actually very interesting because you and David made a show on Friday here live in the studios. We mentioned earlier on, right? I put that up, and it's interesting because there was a complete polarization. If you look at the comments, right, there are a lot of people who really loved what David said, but there are also people who hated what David said. So you really saw a polarization. I don't tend to see the same polarization on our conversations, right? Now, I don't know whether that's because we are more aligned or what it is, but it is interesting just watching the commentary, or whether we're just more gentlemen. I'm not sure.
Maybe David's got some strong views on the political economy, and that always polarizes people.
Yeah,
I guess I look at David. To his credit, David doesn't like either side that much, I think, and thinks there's both sides have a fair share of people doing the wrong thing. But he certainly has some polarizing views. Whereas I'm more about trying to come out with what does it mean for markets. I think there's, I've obviously got my own political views about what's good and what's bad, but there's a lot of stuff where you just have to say, okay, look, if I was a benevolent dictator running this is the way I'd do it, but the reality is I'm not, and the people who are running it do have other things they're trying to, and other hidden motives, and so I need to work out what does that actually mean for markets, and what's that going to do in terms of people's investments.
Yeah, absolutely. Now, there's a bunch of questions coming through, but this is one we'll just touch on briefly. Reese asked, do we ever talk about the World Economic Forum or IMF Great Reset? How will that affect interest rates? Now, there's a bunch of layered assumptions in that question, which is worth just reflecting on, right? Because there is definitely a thematic from the globalists who are calling out particular things about alternative futures, you'll own nothing and be happy sort of stuff. I have made some shows on the Great Reset, but I also think it's a very, very fuzzy term. And when you try and peel back the onion as to what it precisely means, I think it's very complicated and difficult to work out precisely what anybody means, because I don't think it's as clear as perhaps some would want to claim it is. They are saying that we can't go on the way we are going on, and they do talk about climate change, and they do talk about equality around the place, and they do talk about easing some of the debt issues. But Damien, do you have a different perspective to me on this?
Well, there's two parts, I guess. I'd say one is on the equality side, and the other one's on the job situation and wages. So I'll start with the equality, but I think I could do a whole show on this one, and we still wouldn't run out of time. But the nutshell view for me is that we've seen increasing inequality for the last number of years. My personal view is I think a lot of that's been driven by communism was sort of meant that, and the threat of communism sort of back in the 60s and 70s meant that capitalist economies had to be sort of on their best behaviour, and they had to be relatively constrained and actually say, yes, we do need to share the wealth because we don't want a revolution. And then in the 90s, we sort of all of a sudden had the end of communism, and I think capitalism become a bit unconstrained. And I think that just leads to this widening inequality. And the problem with widening inequality is if I take $1,000, give it to Jenna Reinhardt, she just throws it on the pile. I take $1,000 and give it to the poorest person, and it's out and spent, 20 minutes later. And so, and that just means you have this build-up of some people with lots of money, and you have this demand, this problem with low demand, and that's exactly the problem economies have been complaining about for the last 15 years. Is where's the demand gone? And for a while there, it was hidden because we lowered interest rates and we let everyone borrow in order to get the stuff they wanted. And so that sort of, we had the 2000s, most of the sort of early 2000s, where as I said, the wage growth that we were seeing was, the lack of wage growth was hidden because people could go out and borrow to buy the car they wanted or the house they wanted and things like that. So I do think that inequality is the sort of major issue sort of going forward, and that really colours my view about whether we're going to be seeing this deflationary sort of pulse, or whether you're going to see you actually will get a genuine inflationary pulse. Okay, so that was one side of it. The other side of it's one we've spoken about before, but I'd love to hear your views again on it, because I'm sort of painting two pictures, and I don't really know which one is the right case. And one picture is we're seeing record levels of quits, particularly in the US. We're seeing quite high job unemployment as well, but employers are talking about how hard it is to find employees. And so does that mean we need to see wage rises, and that sort of drives the next round of growth in terms of it does actually help improve that inequality by getting wages out? Or, are those exact same symptoms that I was talking about, are they actually showing that people actually don't care much about wages, and they're actually saying, companies are saying, okay, pandemic's over, it's time to come in the office, 4 days a week. And people are saying, well, no, actually, you know what? I'd prefer to go work for a different company where I don't have to come in 4 days a week. Or, I'll take a lower paying job in order to be able to live somewhere completely different and work from home all the time. And so I think there's been in a lot of the surveys, particularly amongst sort of the younger generation, there's been this real thought about, is life too short? Is life too short? And so if that's the case, then what we're going to see is lower wages, or lower wage growth certainly, and poorer productivity for companies, and probably widening inequality. And so companies, and when I say poor productivity for companies, because you've got a bunch of people working from home or working 3 days or 4 days a week rather than working full time, and maybe you need to hire a few extra staff and sort of have those controls. So companies start don't make as much in terms of profits. And so I look at both those scenarios, and I can see good arguments for each, and I don't know which one's more likely. So I guess that's where I'm throwing back to you and your surveys, Martin, and saying, which out of the two, which do you think's the more likely scenario?
Well, I actually think both are actually true. I'm not sure it's an either or. Right, there are definitely some people who have had a significant wake up over the last couple of years, and it's coming down to what's really important for me. Is it really important to be in that high-paid job, despite the fact that I have to sit on a train or I drive for an hour and a half or 2 hours every day, right? Are there alternative jobs where I can actually do the things I want to do in a less pressured environment, perhaps using internet and perhaps using, distributed processes? That's quite strong. And I am seeing also a lot of people, particularly younger people, who are actually actively moving now because they can't get wages growth where they are, but if they actually switch to a different firm, they can actually get wages growth, quite significant wages growth. So those two things are definitely happening. It's not uniform across all sectors, high tech, some finance, and a few others. So that's the sort of the first one. The second one that I'm seeing is a lot of people who are so debt laden that they are really quite scared about where things are at the moment. And all this talk about higher interest rates and cost of living rising and wages not rising, a lot of them are getting increasingly concerned about how this plays out, because in the early 2000s we had significant high levels of debt, but we also had very strong wages growth. So people got out of jail no problem, given 2 to 3 years, right? But it's not happening this time. And in fact, what they're seeing is a spiral down where the debt is getting more and more of a sort of a grip on their throat, and they've got no way of getting out of it, and the wages growth is not there, and the cost of living are rising. They are not actually wanting to switch jobs at all, right? They just want to stay where they are. Right?
Yeah, and if you're sitting on a massive debt amount, saying, okay, do I want to move to a company and then have a probation period where I can be fired, with a week's notice, and potentially because of lockdowns or pandemics or whatever it is. And so there's and I think there's a lot of contractors as well that sort of went through that part about just big banks and things like that just turned around and said, everyone's gone. If you're a contractor, we can get rid of you, so we will.
And I was going to say, there's an interesting subtext which you've already touched on. There are a lot of people who were contractors pre-COVID, and they suddenly realised that was a very fragile environment. Right. So some of those are actually looking to get back into the workforce, even if it's at a lower paid level, to be able to get more certainty. So there's a really interesting contrast, and it's not uniform across states. It's not uniform across even ages.
Industries.
right? But it's important to understand. Now, this Great Reset thing, right? One of the things I come back to is the underlying thread here is ever more debt, right? And if you look at the average duration of a mortgage in Australia, it's now, in many cases, 35 years compared with 25 or 20 years a few years ago, right? And around the world, we're seeing this again and again. So effectively, we've got more and more of the population in more debt for a longer period of time. And one of the things I keep saying is, you are a cash flow, right? And it seems to me one of the things that the Great Reset was on about was potentially recognising that people are a cash flow because you don't own it anymore. And in fact, you may have a mortgage on a property, but is it really any different from renting? Right? You don't really own it, right? It's just that in the good old days, you paid it off in 7 years and then you owned it. Now you own it for 35 years, but you only you're only paying it as you go. So there is something really quite pernicious about this, which basically says, well, top end of town's going to get ever so much richer because they're the people who are actually providing all these services and the financial services sector, etc., and the investors love it. But you need the minions to go on paying and going on paying and go on paying, going on paying, right? And then if you look carefully, Afterpay and the other buy now, pay later facilities and some of the other things there, it's all about getting people more wired into debt. And one of the interesting things I see in my surveys is that particularly those people, let's say under 45, and as you go down the cohorts even more so, they just assume that debt is part of the furniture. They will always have debt. So in a way, what they have done is they are playing the game that the big end of town want them to play. Because if you don't have debt, you actually aren't worth anything to the financial service organisation unless you have large assets and then you're on the wealth management side. Yeah.
It's Japan had 100-year mortgages at one stage there. They're rolling out. So the question is, at what stage is a 100-year mortgage? How different is that to just renting? Yeah.
And then the other side of it is, and it's the other thematic in this idea of the Great Reset is, well, is there a small, powerful cohort basically calling the global shots, right? And of course, then you get into, well, of course, the COVID is, et cetera, and well, I'm not going to go there because I'm not sure that's proven. But the point is, you can create this edifice, which is, I guess, based on neoliberal thinking and all of those things. And I've spoken to a number of people, like Steve Keen, for example, a couple of weeks ago, who's called this out and saying, you've got to understand the game. Now, I'm not sure that the Great Reset, as proposed by the World Economic Forum, changes any of that stuff. It seems to me, if anything, it continues to drive it in the same direction, right? Because essentially, if you peel it all back and try and understand what they're actually saying, it is not fundamentally different from what we've been doing for the last 20 to 30 years.
Yeah, and I think it's that part. If the encouragement is still to, and the process is trying to get people to take on more debt. And we've obviously pushed interest rates pretty, maybe not as low as they can go, but pretty close. Then, I guess it's this thought about it's a game you can keep playing until you can no longer keep playing it, but there's probably a bit more left in it, I guess, if they want to. Yep. It'd be nice to have somebody go, yes, we do need to move away from this, and we need to come back to more. And in a way, I think the pandemic did that. In terms of the big cash flashes and paying out money. Obviously, companies made out like bandits in Australia and other countries as well. But for the large part, there was a lot of money going to poorer people. The problem is, obviously, you can't pay people to do nothing. You can for a short period of time, but you can't for a medium period of time. Yeah. Well, I mean, my big problem with the universal basic income, and I must admit, when I used to be on the side of saying, look, I think universal basic income would be good. My main problem with it is that I think people need purpose in their life, and I think if you're giving universal basic income is the equivalent of rich parents saying to their kid, you know what, you're useless. Here, have some money. Go keep yourself entertained. And I don't think that's I don't think that's a good formula for a healthy society.
So
I think you're better off.
I did an interview about 18 months ago with a very powerful academic who's done a lot of work on UBI and put some of those questions to him. And he said, it's interesting, where they've piloted UBI and basically taken some of the pressure to work off, people don't just sit around doing nothing. They do the things that actually are useful to them, but also useful to the society as well. So it actually is not necessarily all negative, right? Now, I'm not necessarily advocating one way or the other, but there's an interesting philosophical point here, because if you take the neoliberal view, you've got to work to pay the debt, right? That's how it works.
Yeah. That's well, okay, and I will take I'll take the point that that I do think there's more support you could put for people in terms of making sure that people aren't falling through the cracks, and that they can choose to do things without having to feel as if they can't have a life.
Yep.
It's sort of that part about going, yes, I feel as if I can take 6 months off to do whatever, and to help care for partners, or to help kids get through whatever processes or whatever, without feeling as if that's all of a sudden I've got this massive debt burden that's going to drown me. So I do take that point, but I think from my part is it's not about saying as society gets richer and richer, and economies get richer and richer, that we just end up paying more and more out as UBIs. I think it is well worth saying there is it's worth having a level that people can survive without, but I'd love to see more put into research and development, personally, actually say. Yeah. And a lot of the research and development that just companies, I look at companies all day long, and I look at what companies are investing in and all that, and they will do research and development for things that are pretty sure bets, but they really very rarely do the very speculative type of research and development that you really do need governments and universities to do, where a lot of the time people just wasting their time completely for years and years and years, but every now and again there's just this breakthrough technology that then funds this huge next leg of growth, and that's not the type of thing you can expect companies to come up with. Absolutely.
Now I want to sort of shift the conversation forward a little bit. There's a couple of areas I want to touch on. This chart, I want to show this one. This is actually the Americans' cash in the bank, right? It's running from 1975 up to 2020, right? And it shows you basically the percentage growth, right? Never before has so much money been held by a proportion of the population, and that's partly towards government handouts. Now, we know the savings ratio in Australia is also quite significant, but we also know from my surveys that represents about a quarter, maybe a third of households. The others have nothing.
Yes.
Going back to your inequality situation again, right? And it seems to me that we've created this situation, and partly the government stimulus, where we've got this huge skew between a small proportion who have a lot and a lot of people who have very little when it comes to this. And I wonder how sustainable that is, because a lot of those people who have the savings can spend it, and we're seeing that even now. But if you haven't got it in the first place, you can't spend it. And I wonder whether that's an economic drag on the economy that perhaps people aren't recognising.
Yeah, absolutely. And part of the, I guess for me, part of the expectation was that at some stage, a lot of those people are building up their saving because they're not doing things they would have otherwise have done, whether it be eat out at restaurants most nights of the week, or go on expensive overseas holidays and things like that. And so I think for a certain type of person who is was relatively affluent and already, they're building up this cash because they can't, they haven't had the opportunity to spend it. And if we are going to see continued lockdowns and shutdowns, and really I think it's the uncertainty part where people will be concerned to travel if they're not quite sure if they're going to get locked down. It might not be that people, I think, might be over their health concerns and worries, but they're like, well, do I really want to go to say South Africa and then find that I can't get anywhere else? I'm stuck there because everyone's shut the borders. I think that type of throwing that type of extra uncertainty into it means that they're less likely to spend that money, and so potentially those imbalances will last a bit longer. So I think I could probably say in terms of I think into the mid 2020s, I've got some quite positive, views on productivity. I think there's particularly energy costs. I think are going to be reaching pretty close to their peaks. I think there's a lot of solar and wind power, and it's actually mainly the battery side now. I think I've probably done it a couple of times on your show, but I've got a piece coming out next sort of week or so to sort of re-looking at all these the costs, and given the fall in cost in batteries, I think there's a pretty decent argument for saying energy prices are going to peak over the next few years, and there might be this thing about oil prices, or maybe coal prices shooting up, but they're almost at the stage where it will actually be cheaper in countries like Australia to close down a coal-fired power plant, because the cost of the coal alone will be more expensive than the cost of the solar plus battery. And so, so I think there's not quite there yet, but I think I'm quite hopeful. Like, just following the trend of how this has been going, and a lot of it's really just based on more production, and just seeing that more production. If you've got to produce 1 million units, your costs are X, but if you get to produce 10 million units, then they come down. And so I'm quite positive on that side, and so the electrification of vehicles and potentially driverless vehicles as well. I think there's a lot of real positives to productivity that could come out, but we've got this troubled period in between, very high valuations, and China's got to deflate its debt market in the meantime, and so. Will we get enough government stimulus and everything thrown at markets so that they can actually hold up and sort of bridge that gap into the the mid 2020s, or is that just too far? And you'll see markets eventually pull back, and it will be a while before we can you go through some pain first before we get it, before we actually see the resultant sort of hopefully improves inequality from that.
Right, and the fact of the matter is we don't have balanced competitive markets. We have markets that are pretty much supported by central banks, all that liquidity that they've thrown in. No one's allowed to fail, as we've discussed on previous shows, right? And so the whole idea of capital flowing to the more efficient ends of the market rather than actually keeping everything alive is pretty much not working. We have a bunch of zombies out there at the moment.
That's right.
Nobody.
But the benefit is good companies get really cheap capital as well. But the downside is there's a lot of bad companies getting capital that probably should just have fallen over and left their industry to better companies, or to more efficient ones.
Yeah, absolutely. But the moment, if you talk to people around the world, they're all saying, well, hang on a moment, nobody's failing, right? The failures are much lower than they were previously. Even small businesses, and there's lots of small businesses that are really wobbly at the moment, but they're managing to hang on as well at the moment, right? And it's partly a function of low interest rates, and it's partly a function of some of the money that's still flowing through. I guess,
and a lot of regulations were changed as well.
Yeah.
So that's sort of the. It's interesting because you speak to. Because that's sort of this question: is there this latent amount of companies to fall over? And you speak to some insolvency guys, and they tend to say, "Look, companies usually fail for there's breakdown between partners, or there's a competitor moves into their industry and they're stuck with old technology or whatever it is." And they seem to think that if you threw those failing companies some big cash splashes, an extra 50 or 100 grand, like we have, that all you've done is delay the inevitable. They're still, if they're still the worst player in the sector, or they're still, the partnerships, dissolving or whatever it is, and so there'll be a catch-up period. But there's another argument that sort of says, so I guess that's for the people on the ground. There's a reasonable economic argument, though, in terms of saying, there's some of these companies were they've had a shock, and they've basically gone, okay, I've had this shock. I might have gone broke, but all of a sudden the government threw all this money at me, and now I can actually change my business so that reduce my costs and sort of rebase myself for a new economy. And so maybe you won't get as many as that whole cash splash might have been just enough to get them through, and they've reduced the number of employees and put in more stuff, and so maybe you won't see as many. So I think I'm probably sitting somewhere in between the two, but I can see. I guess I'm nervous about, will there be a catch up of insolvencies at some point as the cash starts to run out? But
well, it's funny because I've spoken to a few insolvency practitioners over the last few months, and they keep saying it's coming, and I say where? And I see it in my surveys, the SME surveys. I have a lot of people who are close to the edge, and they're saying I probably can't survive for another 6 months, but they're still there, right? They're still hanging in there. So it is interesting to see whether in fact they can work through, or whether ultimately it all sort of completely comes and hits them over the head. And maybe if we get another series of lockdowns, that will be another sort of attempt, unless of course won't make a difference. Maybe if the government just keep on throwing more money at it.
And also I think the insolvency guys tend to say that the most likely person to pull a pin is the tax office. They're the ones who probably haven't been paid with their PAYG or whatever it is, and so it's part of their process. Yep. And the tax office has been uncharacteristically friendly, and with an election not until May next year. Who knows?
Yep.
Yeah. Then maybe they'll continue to be uncharacteristically friendly for some time.
Just want to make this comment. A few people have been asking about ISO 20022. Now, I know nothing about that, so I can't comment on it.
Google that first.
Yeah, so I've made a note. I'll have a look, and I'll come back to it. So it's not that I'm ignoring it. It's just that I don't know what to say about it. So one of the things that you'll understand from me is that when I don't know about something, I will tell you I don't know about it rather than just bullshit. So that's what I'm going to say on that. Now, Damien, can we talk about bonds?
Yes,
right? Because the bond market is, of course, a very critical part of the total financial infrastructure, and we saw the longer-term bond rates move quite significantly once Powell said, maybe inflation is not going to be short-term, maybe it's going to be something we're going to have to tackle, maybe tapering is going to start. There's been quite a lot of movement, though. What's your read on the bond markets? And, is the bond markets leading the way, or are they, mirroring what's going on elsewhere, or are they lagging? What's your take?
Well, one thing to note is, look, bond markets certainly haven't been pricing in as much inflation as what I guess they're certainly not pricing very much inflation. Nowhere near the levels of inflation we're actually getting in terms of bonds. So I think from that perspective, that's worth keeping in mind. In terms of how they're pricing, particularly within Australia, I think we're pricing far too much for a New Zealand or a Canadian outcome. And I do think there are other issues, and Australia's debt levels are higher, and all these other things. So I've been using the opportunity. I use sort of that real spike in bonds to buy some of the longer term bonds, and so they're sort of starting to make some small profits, albeit. But as markets are sort of steadied up, I don't know how much further down. Until we really see inflation abate, I don't think you'll see that bond yield fall dramatically. But I look upon that as a great little optionality in terms of hedge. I don't think there's a lot of downside in terms of So remembering that there's an inverse relationship between price and yield. I don't think there's a lot of downside between buying bonds as long as you're not going too far out the curve. At the moment, I do think there's still some that'll keep coming in further in Australia, and the question will be, I think what we're talking about there. If you headed to 3%, then I'm going to be wrong. it is pretty hard to lose money on bonds over the long term if you're buying government bonds. That is, they will come into because you already know where your cash flow is going to be when you get them. You'll get a low return, but unless you're actually out there trading them, your risk is relatively limited. And it's a question of using it as an option on the rest of the market. Is saying, yes, you're not in there because you want to get a 2% yield or a 0.5% yield. You're in there because if the markets do tumble and inflation does pull off, that the value of those bonds will go up, and you're using that as the optionality there to be able to buy equities at cheaper rates. So that's on those side. Corporate bonds, I'm not touching in terms of where they are. I think the big issue for corporate bonds is that the interest rates you're getting just don't, they're not worth it in terms of the default risk. So if you're buying bonds, say with the Australian government, they own a printing press. I'm pretty confident that push comes to shove, they're happier to inflate their way out of it than what they are to default in terms of their bonds. And Australia doesn't have a large international debt they have to worry about. Whereas corporate bonds, if you're buying things at a 1.5% yield that are relatively risky, then that's where I guess the danger for me is. So it doesn't necessarily flow into all types of bonds, and we've seen the Chinese developer bonds, exactly what can happen when the chickens do come home to roost. So there's plenty of bonds out there that were you could have bought for $100 year and a half ago, and with a sort of 3, 4, 5% yield, and now these things are trading at $20 of your $100. So you've lost out on those, and I guess there's other corporate sectors that I'd be concerned about the level of yield you're getting versus the risk of return.
And it's interesting because in Europe, of course, the longer term bonds are still negative, right? So effectively,
less negative they used to be, but they're still negative.
But they're still negative, right? So basically, you can get a 10, 15, 20-year bond. So basically, it seems to me the government's basically it's cheap money, right? Free money.
Yeah, well, and this is this issue about they're effectively keeping the banks solvent. Really, is what they're trying to do, and by giving the banks a spread, and a lot of that was their I can never remember the acronym. They've got a 5-letter acronym for basically that why the EU pays the banks to lend to people, and so in terms of that, if you're relying on your central bank to keep your bank solvent, there's almost an argument in Australia that the central banks are closer to the banks, which is why we've actually seen bank profitability hold up quite well over the last little while, because they're prepared to do more to help the banks because they potentially are closer to the regulators over here. So as long as that continues, but the problem is if it doesn't continue, and that's the banks really do suffer from that low interest rate environment where they just can't lend at they can't get the earnings spreads that they used to get, and profitability suffers. We haven't really seen that much of it in Australia, but the potential is definitely there.
Well, the term funding facility, of course, that lovely facility where the Reserve Bank basically gave cheap, quote, free money, pretty much free money to the banks. They just feel free to lend it, right?
Yes, absolutely.
To be repaid over the next 3 years.
Yeah, but basically lent. The banks got to lend from the RBA cheaper than state governments could do. So
exactly right. Yeah. And as a result of that, CBA, for example, they had a 4 basis point improvement in their profitability thanks to the term funding facility, and they were able to actually buy back some of their shares. Let's be clear, taxpayers' money flowed across to the banks.
Yeah, no, but you hardly saw it, Martin. It didn't hurt because it got spread so thinly. Everyone just paid a little bit to help CBA, so it's and it's complicated. Yeah. And it's complicated. So, yeah.
Well, I have to say that that this whole term funding facility, and of course, then all that money went back, and is sitting inside the Reserve Bank at the moment in their accounts at the Reserve Bank. There's more bank deposits there than they actually got from the Reserve Bank in the first place. So
yes,
it just went around the houses, right?
Yeah.
But it does prove the point, and this is what I keep saying: Australian banks are underwritten by the government, directly or indirectly, right? the markets basically assess them as protected species.
Yep, absolutely.
Yeah,
absolutely. And it is so. Yeah, your biggest question for the profitability of the banks is how much are governments and central banks going to let them make in terms of their profitability.
Yeah.
So I've sort of taken the other side of it in terms of saying I prefer to be underweight. Like we're not, the bank's such a big sector that, and my funds, the Walk the World fund is designed to be this sort of core fund that's a low risk fund that's sort of meant to sit in there. So we've got limits as to how far overweight or underweight a particular sector we can be. So we can underweight a sector, and certainly for banks that's one of those sectors. Some of our investors choose to get rid of all the banks completely, but the danger is that in terms of the banks is that you get rid of all your banks, and then the government comes and helps bail them out in terms of funding facilities and rolls out all these things to keep them more profitable than what they should be.
And just to underscore, in Europe, the ECB is effectively subsidising directly or indirectly the profits of the banks, aren't they?
Oh, absolutely, and to that level, it's you can pick up in. I haven't checked in the last 6 months, but I'm assuming it was there 6 months ago. I'm assuming they still are. Is that you can pick up a mortgage for about 0.5% in somewhere like Germany or France, and the ECB pays the bank 1%. So you borrow 100,000 euros, you're paying 0.5%. So you're paying 500 euros to the bank as your interest. The central bank takes your 500 and doubles it and gives that money to the bank, just for the pleasure of lending you money. So they're very much and there's a lot of they're very much supported by the central banks, and profitability hasn't been particularly good at all.
Now let me just put this chart up because I found this quite interesting. This was actually from Bloomberg's. Making the point that Americans haven't bought this much stuff in a decade, right? So basically, going back to our conversation a little while ago about all these people with money, they're buying stuff, right? So it's not services, it's consumption of goods that's actually driving the economy at the moment. And I think to an extent we've got something similar here. Very hard to get a read on the services sector because you don't have the same metrics. And I think the information coming out from the national accounts over the next couple of days we'll be looking at to see what the service sector looks like, because I think we're going to see a similar thing to what's happening in the US, where people are buying stuff, services sector not so much.
Yeah, absolutely, and that's the reversion which I guess I'm expecting to come through is that the amount of stuff that people are buying will decrease as services become available. And I spoke about travel in particular being the big one. People who might have had an annual holiday and spent $5,000 or $10,000 on flying their family somewhere and holidaying, are stuck at home and so have had to do something else with that money. It might be the new couch or the new TV or whatever it is. And so, will they keep on buying those, or is there actually a little bit of a hole coming in terms of the manufacturing side as that starts to fade off and people go, well, yes, I just bought a new couch last year, so I don't need to buy one in 3 years' time. I can wait 5 years or 6 years before I buy the next one. And so for the numbers I've seen, the services side is sort of didn't quite fall as far, but it's certainly down still and rising. So they do seem to be very much a mirror image of themselves in terms of what you're seeing in terms of the manufacturing coming back to trend. The service side is sort of bouncing as well and coming up to sort of meet that line.
Absolutely. Well, it'll be interesting to see. I should be fascinated by the accounts because the early lead indicator on the current account showed that in fact we got a huge surplus, right? 23.9 billion in the third quarter. Just think about that in the context of everything that's been going on over the last year or so. That's a remarkable number, which sort of says, well, something's going on. I'm not sure I understand precisely what's going on, but that's a big, big, big surplus.
Iron ore, coal, I'd say. I've seen I haven't seen the breakdown, but yeah, it's most of that surplus is iron ore and coal.
Correct.
And to put it in perspective, we've got these if we're right that the Chinese property sector will slow down to even where they were in 2015 or mid 2000s where they were it was growing really strongly. It was moving like 15 million people a year to city, 15 20 million people a year into cities and urbanizing and growing all these apartments, but it just wasn't at the level, it wasn't at extreme levels it is. So if you just said it came back to those type of levels, you've got to wipe out a significant portion of the of iron ore producers before you get there. And the issue we've had is that the prices rose so quickly that you didn't have time for all the high-cost mines to come on before the prices were falling again. You need to start really digging into, say, a Fortescue or someone like that, and actually get some of these big miners to say they're going to stop producing because prices are too low. And to get that to happen, you probably need $30 iron ore price, maybe $20, and just to put that in perspective for people who don't watch it as closely, so it was $200 something not that long ago, like in the last few months, and so then back down to 100, and so the companies are still wildly profitable at those levels. That will put a big dent in the coffers of Australian governments.
And it's interesting because Vale, the other big producer of iron ore, came out and said, well, our production numbers are going to be down ahead, right? And that immediately had a positive impact on the iron ore price and on the miners here in Australia.
Yeah, that's right. So we've seen those prices rally, significantly recently. But I think as well, it's partly about what Vale said in terms of production being limited. But I think there's also there's a lot of people reading into some Chinese. There's been a lot more news about Chinese support, and I think if you're buying an iron ore miner, you're basically taking a bet that China's going to fold and they're going to start funding all the property market again.
Yep.
So what we've seen, in my read anyway, of all the announcements that have come out, is more of just a no, we're not bailing out the property sector, but we're trying to do everything we can to peripheral sectors to make sure the whole economy doesn't fall over because of the property sector. But I don't think they're anywhere near at the moment stepping in and restarting that whole property. Trying to restart that whole property building boom.
No, and interestingly, some of the latest data on rentals in China also shows they're dropping as well, right? So you're seeing this spillover. Right? So it's interesting. It's going to
and I think they will try and keep prices high, like they're because home ownership's level so big in China. So they sort of, but keeping prices high is not the same as building lots of apartments. So they will try and do what they can to sort of keep that, because they don't want they don't want a housing crash in terms of prices, but they do want to stop building tens of millions of apartments every year that aren't needed.
So as we come into the last sort of chunk of the show, I want to ask you, I had a few people ask in the show and also prior, the markets are still very fully valued at the moment.
Yes.
In terms of fundamentals. So what are the things that you're looking at, and are there other sets of indicators that you look at other than just the sort of the value set to try and actually figure out where the opportunities are versus where the traps are?
Yeah, absolutely. Look at hundreds of different factors sort of within it. Some of the key ones I look at tends to be dispersion type measures. So what we look at a lot is are companies trading the same, or are we actually seeing this real divergence in terms of the way companies are trading? Because oftentimes when you see this real divergence, that's sort of the preemptive signs that you're going to get a big downturn. And you can look at that in the options market. You can look at that in short selling. You can look at that in valuations. You can look at it in terms of price movements. There's a whole bunch of different ways you can look at these, and they all have these different predictive capabilities. And one of the issues in terms of running quant models is that you can go back and find these fantastic models that would have made you all this money, and then you say, great, let's now run that, and then the next thing you know, it all falls over. And so a lot of it is about knowing why they did it. And so there's plenty of models, especially over the last sort of 20, 30 years, where we've got the best data that really basically just when it all boils down to it is a prediction that effectively interest rates are going to keep falling. And so if that stops and you hit zeros, then those models all of a sudden become useless. So The valuation type measures, the absolute valuation measures, so they've been saying for a long time, it's time to sell. They give a lot of false negatives because where they give false negatives is where you see earnings really strong. So, Trump gets in and immediately says he's going to cut all these taxes. Markets look like they're really expensive, but hey, you know what? When your tax rate gets cut from 35% to below 20, all of a sudden you're a lot more profitable and you're actually cheap relative to where you were. So those types of things. You also saw sort of in the early 2000s, markets looked a lot more expensive than they really were, but we had this really strong earnings growth that sort of meant that sort of carried away that, or that meant that overvaluation disappeared. The ones that are starting to turn at the moment now that they're a little bit more predictive are some of the ones that look at the dispersion rates. So when you get a bunch of companies that are quite expensive and then most other companies end up being quite cheap or getting cheaper, that often is a sign that things are about to turn down, and that's sort of starting to hit some quite extreme levels. It's probably not at really extreme levels, but and you can pick your measure. Different measures show that in a worse or a better format, but it is starting to get to the stage where there's at least an amber light there to say you need to be watching what's going on, and that could be giving you some signals. Some of the debt markets usually give that signal as well. The corporate debt markets. The problem with the corporate debt markets is that there is government intervention sort of as limited the amount. So if you're basing some of your measures on corporate debt, you'd be saying actually there's no problem whatsoever, everything's fine. You'd obviously look at some of the emerging markets like China and say, okay, there's major problems, but there's often subsectors that are sort of having problems wherever you look. So yeah, there's always, I guess you can always find a signal somewhere to tell you that it's almost midnight and it's time to get out of the party. But for my sort of best read at the moment is there's a bunch of ones saying that we're close, but they think it's somewhere in the hour before midnight. There's a couple that are saying, we're just about to hit, clock's just about to strike midnight and it's time to be looking out. But then there's a whole bunch of other ones that are saying, no, everything's fine. And so it's a matter of trying to work out, which of these is important and which of them are being distorted by other measures.
Yes, and there are people who've been calling for a significant crash for 5, 6, 7 years, and they keep pushing it on, saying, well, of course, the central bank keeps pumping. It's going to happen, but it's not going to happen straight away, right? And of course, the point is, if you actually bailed out 5 years ago, you would have lost all of the momentum that we've had in recent times. Which, by the way, is why a couple of years ago we got together, because I firmly believe that you've got to be into this, exposed to the markets, because if you're not exposed, you're going to miss out on such significant momentum. But you've also got to be sensible about it, right? That's
absolutely, yeah. And so it's about having that building up that spare cash in times where you do think it's overvalued, but keeping an exposure to the market in case you're wrong, or in case something surprises you and government step in and bail out or throw more money at the situation, with the view that you want to keep at least some exposure, and then when markets do pull back, that's where you start switching out of your bonds and back into your equities, or out of your cash and back into equities. So for us at the moment, we built up a fairly decent sized sort of war chest with a view that of cash relative to our sort of benchmark positions, and so with a view that we will see markets pull back, especially as more Chinese news comes out. But I'm the first to admit I can see scenarios where a little bit of bad news and central banks come out and throw a bunch more money at it, or government step in and more bailouts, and the market off it goes again.
And it's interesting because my own experience of buying particularly stocks is that when everyone else is selling, it's worth just hang on a moment, is that a buying opportunity, right? And if you think back to, when COVID first hit, the markets dropped dramatically. Now, I confess, I did go in once we got to the point where I thought, well, actually, those stocks are too cheap. They're going to come back, right? Now, they may not come back in a month. It might take 6 months or a year, but they are fundamentally still good value stocks. And that's the point, isn't it? That the market overall might come back, but that doesn't mean that the value is completely destroyed.
Yeah, and it's an issue about saying, look, are you in here trying to make, do you want to pick exactly the top and pick exactly the bottom? Is that the game you're trying to play? Or are you trying to make an investment for the longer term, and you sort of want to, you don't want to be jumping in and jumping out completely with the view that you're going to be realising capital gains and having tax issues and all that. What you're really trying to do is to trim the sails a bit every now and again, and then unfurl the spinnaker every now and again. And so, it's a question about we want to keep sailing forward, but it's a question of it's not being completely in or completely out, because you are going to run into tax problems, and the world is an uncertain place, and so
yes, absolutely. And I always say to people, there's no such thing as a dead cert investment, right?
Yeah, absolutely.
Every investment class, be it gold, stocks, bonds, crypto, whatever you look at, right? They all have different characteristics of risks. There's no such thing as a dead cert, right? And anybody who turns around and say, I guarantee this return, don't believe them, walk away, right? Because it's not true,
absolutely.
Right?
And just to put it in perspective as well, because I often speak to clients and investors who talk about the types of returns, and you'll find there's a couple of people out at the moment talking about their 1 year returns of being 20-something% and all these types of things, and talking about as if that's the type of return you can expect from these investments. But over 100 odd years, you generally find equity investments will sort of give you about 5% above inflation. Maybe 7%, maybe 4% above inflation, but you're in that sort of, so if inflation in Australia is going to be 2 to 3%, then you sort of be expecting over the longer term to be getting around about that 7% return. The issue is, if you're buying at particularly high valuations, maybe that turns into 2 or 3% above inflation, and if you can buy it at cheap valuations, maybe it ends up being 10% above inflation. But I think there's the idea that there's this magical 20% plus returns you're going to get out there is not a good expectation to go in terms of markets, and I see a very different from people who have money who tend to come to us and say, okay, I've made a bunch of money, running my business, selling my house, doing whatever. I've been rich and I've been poor. I don't want to be poor again. Don't lose this. I want to keep up with inflation and get ahead of inflation, but the main thing I'm trying to do is not lose it. And other people approach it as, here's a small amount. I want to become a millionaire. Go and roll the dice and throw it. And that's not really that's not where we play. And I think that's the dangerous way to look at investing, is saying, this is the way I'm gonna get rich. And because there's very, very few investors who you can point to, rich people who you can point to and say, they got rich by trading the market. And most of the ones, even that, the big investors you might talk to about, your Warren Buffetts and people like that, they run financial services firms. That's where they make most of their money is not from going out there and starting with $10,000 and managing to trade that into millions and millions of dollars. It's from running a financial services firm that is leveraged often, and or the big hedge fund guys who are charging 2 and 20 to their clients, and that's where they've sort of got a lot of their fortunes from. So really do urge people to look at the longer term returns and not treat it as a casino. Can I suddenly hit the jackpot and make all this money? But it's more of a I'd like to use that to protect my wealth and to grow rich slowly, not as a lottery ticket.
And you could almost say there is a fundamental difference between investing and the speculative trading.
Speculating,
right? Which is speculative, and you might win, you might lose, but the chances are over time, the round and walk down Wall Street says you'll win as often as you lose, and therefore you probably won't actually end up that far ahead.
Well, yeah, and look, and I guess on that side, at least the stock market does generally go up. Whereas if you pick something, casino for example, they always take a margin. So I know that if you keep playing that for long enough, eventually they'll get their margin, assuming a fair game and all that sort of stuff. But that they're going to be getting there. If you look at, say, a forex, something like the foreign exchange markets, that often people are encouraged to There's a lot of TV ads and internet ads that sort of encourage that. There's no real. There's no winner or loser in the forex market. You actually net you're going to lose because for every winner there's a loser, and there's somebody sitting in the middle taking a small or sometimes a large commission in terms of the trading, and so the net effect is there will be more losers than winners. Whereas at least when you're looking at stocks and bonds, you can sort of go, well, these things are generating returns, and as a cohort, they're generally increasing their earnings, and so the odds are in your favour. But it's not necessarily a good reason to try and turn it into casino, though. Yeah, and you can certainly use enough. You can use enough leverage and stuff like that, pay enough in trading commissions to turn the odds against you.
Yes.
So
I was going to say things like fees and commissions and things you got to watch as well. Now, yes. Jason put this question up, and Jason, again, thanks for the super chats, greatly appreciated. Do you think the problem now with so many investors who need money will drop their rental empty investment property as they get more desperate and they don't have any other choice but to try and keep the wolves from the debt door? I'm certainly seeing in my surveys a lot of property investors panicking now, putting more stuff on the market, trying to work out whether they can take any rent. I was talking to somebody the other day who actually have 4 rental properties, all of which are in the same block, none of which are let, and he hasn't been able to let it for the last year. And basically, he's used up all his reserves, and now he's saying, "Well, what do? Do I try and rent it really cheap, or do I just try and sell it?" And of course, when you put it on the market, then the agent says, "Well, you have to, take a hit there." I am seeing a lot of that in the investment sector, particularly in the high-rise sector. So I think this is a really interesting question. It certainly does, beg the question about how does the property market play out, specifically the high-rise.
And so, but you are seeing rental growth though, because I guess most of the agencies are now reporting that we're actually seeing, and I think it's obviously a net figure across cities, but and it's from in some cases from a low level.
Houses, yes. Some regional areas, yes. Much less so in some of the high-rise areas closer into the city. And for example, I keep using North Rise. North Rise seems to be a particular black spot, right? A lot of stuff that was built there quite recently, just out of Sydney. Rentals not going up at all. Property values down about 26% from where they were in 2017. Right? Just to give you a sort of one end of the spectrum. Houses, though, standalone houses for let, rents definitely going up. Regional areas, rents going up. So, again, I always say you've got to go granular. You can't take these aggregate average numbers because they're completely meaningless.
Yeah, and that's sort of the tail end of what we were talking about earlier, isn't it? That's the whole structural issue that we had a record build of apartments, and that sort of unleashed into the market just when people suddenly decided they didn't want apartments as much, and we didn't have the international sort of bid for those. So, look. Actually, so the question was, what was the actual net? The net of that question was do we think investors are going to keep pushing those rents down?
Correct.
Look, I think there's sort of these. I think a lot of people go through exactly the same process that I think Jason's talking about there, in terms of saying, okay, I'll drop my rent by a little bit, but actually, if I have to drop it by 50%, maybe I just sell the thing instead. And I know there's lots of commercial property in exactly that same position. We're actually we were in a WeWork building, which had exactly that. They just there was maybe 20 or 30 offices within this, and there's only 2 of them that were occupied. So eventually they closed the whole thing down. And so I think that there's a lot of commercial ones doing the same bit, and they're going to be talking about whether they start converting into apartments and that over the next while. So what are your best upside is that we do see a slowdown in the economy and interest rates drop again, and the floodgates are open to international students, and in particular they come, and because I don't think it's as certain as everyone is talking about. So we've heard premiers talking about catch up growth and bringing all these extra people in. I think it is harder it is going to be harder over the next little while because of COVID and all these concerns people have about traveling is, well, what happens if I get stuck in a country with no family support and not many friends around, and I lose my job and there's lockdowns and all this. Like, I think people will have a genuine fear about moving halfway across the world now that they might not have had, 5 years ago. And so, so your best bet is, that lower interest rates. For me, the base case is more likely that, while interest rates are going to be tough, and I do think we'll have a slowdown, I don't think you're going to quite see the same population growth that we saw in the past. And I do think there's a structural change where people do want to have, they will be trying to build more. We're going through this big build phase regionally and for houses that is just going to draw demand away from that sector. So I think there's a limited upside, I guess is what I'm saying from that. There might be some if everything goes right, but there's lots more scenarios where it doesn't go right. And there's even the scenarios where actually economic growth takes off and interest rates then rise and property prices suffer as a consequence.
Yep. Well, we could talk about migration and things, but we won't do that because we're running short of time. And Vanessa, just to explain, let me put that back there. We were talking about the question of whether, in fact, rentals are likely to go down because people who own rentals are effectively desperate to get some income. And would they then cut their losses? And as I said, my survey suggests that in some cases they prefer to sell rather than to do that. But we'll wait and see. We're nearly out of time, but I just wanted to get one last slide. This is actually a slide that has popped up from a few different ones, but it just shows the inflow of equities has exceeded over the last 12 months the combined inflow of the past 19 years, according to B of A Global Investment Strategy. That's a
concerning chart, isn't it?
That's a killer slide, isn't it? What does that tell you, Damien?
Well, let's have a quick look at that. I mean, 2008 we had this massive downturn, and 2000 big bounce back in 2009, and equities money was still flowing out of equities. So, I guess it does at face value. It does. I am concerned about it. But the Trump years of that 2019, there was a pretty decent market rally throughout that, and money flowing out of the market. So I guess I wouldn't. Yeah, my rough guess at looking at is it's not like a this is the magic chart that tells you exactly how to make money, but. And the markets will definitely fall because they've reached whatever level. No. But I would, it does show that there's a one more warning signal. I wonder how much that would correlate to central bank.
Yeah, I was just doing a bit of quick calculations, and I think there's a very high correlation with government stimulus, right? Central bank money printing, and the debt. I think there'll be some very interesting correlations. And, if you look at the amount of debt in circulation, if you look at the amount of money that's been created, it's got to go somewhere. Well, that's where it's going.
Yeah, and that's that whole inequality argument is saying, in the end, if you have a poorer person borrowing a bunch of money and going and building apartments or spending that money in the and companies or richer people are getting that's ending up then in investments or of some sort, if that makes sense. So there's two sides to every debt. Saying the money, the money's going to go somewhere. It's going to get spent somewhere, and so it's not getting. People generally aren't borrowing it and then sticking it back in the bank. So they're borrowing it and buying something with it. And if that means somebody on the other end is getting richer, then what are they doing with that money? And if it's spread out evenly, it's actually the demand grows and the whole economy goes forward. But if it's very concentrated, you just get that lack of demand and increase in investments.
And I will just mention, last week I had Michael on, who was actually from Emerald Financial, and he was talking about derivatives and the fact that when you've actually got derivatives, there's a multiplier effect, because effectively you might start with a position, but every time that position effectively is then rolled over, you're creating ever more liquidity in the marketplace, and that is actually creating more money. So he was arguing that we haven't actually we've underestimated the total amount of extra liquidity, because the fact that derivatives are also there as well. So it's quite interesting.
Yeah, and look, I take that as well, that the amount of money, and sorry, I've forgotten to plug in my laptop once more. We're almost done anyway. I take into that when I look at leverage, I include some of those derivatives as well, in terms of saying, look, there's a point where you say, okay, margin debt, well, it is starting to get up there now, but for a while there it wasn't as high as what it had been sort of elsewhere in other times. But at the same time, the derivatives have been growing so quickly that that the amount of leverage sort of in the market, there's other people out there. When you buy a derivative, there's often other people who are actually taking that, lending that money to go and hedge the positions that you might not be seeing. Sorry.
He's going to plug himself in before he disappears.
I am plugged in. It was actually plugged in. It was just hadn't been turned on.
Okay. So, yes. Well, I think we've pretty much there, Damien. I haven't covered all the questions, but it's a good range what we've covered tonight. So once again, thank you very much. And the good news is you're coming back for the end of year show, right? At the end of December.
Yeah, that's right. Yeah. I'm having a little bit of time off before Christmas, and then I'm in the I'm manning the fort during Christmas, New Year's. So yes, we'll be in for, is it the 28th?
Yeah, that's right, 28th. So I'm looking forward to that. And we will have a bit of reflection on the year past, but also reflection on the year future as well, because we may know more, we may not. I don't know.
Yeah, that's right.
So thank you very much for your time tonight. And we should just say, Walk the World Fund. You can go to walktheworld.com.au and you can get all the information about the funds that they're actually managed by Nucleus Wealth and Damien. We've got a number of people who actually have used those funds very effectively over the last few months, and explore it and have a look at it. Totally transparent, painfully transparent, some would say, and very flexible as well.
Yeah, that's right. So jump on there. You can cut stocks out. You can either run with portfolios that we're running, or you can just take passive portfolios. And the idea is what we're really about is just giving you that flexibility that we want this to be sort of the core of your assets in terms of the high quality bonds, cash, and stocks, and then let you screen things out that you don't want, and sort of give that ability. Then, if you want to invest in things around that, you can. But certainly more than happy to have a chat to anyone who wants to talk about it, and we have financial planners on staff who can help you. Yeah,
well, I do recommend that if you've got any questions at all. There's stuff online. You can just have a little look, but you can then talk to somebody. So, thank you very much, Damien. I really appreciate your time tonight. Very interesting. Always enjoy sharing perspectives on all of these things, and we'll do it again next month. Hey.
Yeah, looking forward to it. Have a great Christmas.
Okay, talk to you soon. See you. Bye. There you go, folks. And just before I go, I want to make 3 quick points. The first point is you may be aware that my wife is extremely ill. In fact, she's probably just got a few weeks to live now. In fact, the ABC interviewed her yesterday because she's dying from asbestos-related disease. And there will be the drum segment probably sometime next week. So if you want to watch out for that, it will be, I think, quite compelling, because basically she's devoted the last 3 years of her life to researching asbestos, hence all the papers and things and shows we've been putting on Walk the World. And also she's created a charity, and she wants to leave a legacy of people being more aware of the risks from asbestos. So that's the first point. The second point is next week I will be on with my own show, which will be very much the one relating to mortgage stress and households and all of those things. So that'll be on next week. The week after that, I've got Steve Keane coming back on, because I had so many questions for Steve, and I got a bunch of questions I couldn't actually get covered. So Steve Keane is coming back that. And then I've got Leith Van Ulsen from Macro Business the following week, coming on to talk about particularly property and those sorts of things. So the next few weeks before up to Christmas will be very busy. Then I've got Damien on, and the week after that I've got Tony Lacantro coming on. So watch this space, a lot going on, and hang with me. If you find that my posts are a little bit shorter, it'll be because of some of the other issues I'm dealing with personally as well. But I just wanted to share that with you tonight. So thank you very much for spending some time with us this evening. Really appreciate it. And we look forward to catching up with you again on the next show, either one of the recorded ones or this time next week, when we'll be talking all about mortgage stress and related subjects and the scenarios. Take care. See you soon. This is Martin North from Digital Finance Analytics, signing off. Bye.